Welcome to another FAR walkthrough video. I'm Logan, and in today's video, we're going to be going over adjusting the income statement to correct errors. And we're going to be doing that the super fast CPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to superfastcpa.com and check out our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam, and again, it is free, it is only 1 hour long, and we will show you how to be effective and efficient with your studying so you don't waste months or even years of your time. Also, just letting you know, we will only be going over 5 questions in this video, but Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So, if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Alright, here we are at question 1. It was discovered during the quarterly audit that Maple Leaf Corporation included $25,000 of interest expense in the selling expenses account. If necessary, give the correct journal entry to rectify any misclassification. Okay, so the question is there a journal entry necessary? Probably, because we're talking about fixing errors in the income statement, so there probably is a journal entry needed, but why? What would the journal entry need to be? If you have an idea from the previous video and what we learned about there, that's great. If not, let's go ahead and dive into this to learn why this would need to be adjusted. Alright, here we are at the answer. The answer is B. We have to debit interest expense and we have to credit the selling expense for that $25,000. So why do we need to do that? Interest expense associated with the cost of borrowing should be classified as a non-operating expense because it does not arise from the primary business activities of the company. The incorrect recording of this expense under selling expenses, an operating expense category, affects the presentation of both the operating profit and the net interest expense. So to correct this, we have to debit the interest expense because it should have been the one that was debited in the first place, and then we have to credit selling expense to reverse that selling expense so that it's not there anymore. And again, the reason this is important, in case you haven't watched the previous video where I talked about preparing the income statement, there are different sections, especially when you're doing a multi-step income statement. And one of them is operating income, there's continuing operations, there's discontinued operations, there's different things like that. And in the end, it all comes together to be the net income. But it is important to know how much the operating profit is compared to the non-operating profit or loss, whatever that is. And so the interest expense needs to be in the non-operating section. So that's why we had to do this adjustment. And yeah, this is just an intro to doing these adjustments on the income statement. Let's go to the next question to learn some more. All right, here we are at question 2. During an internal audit, it was discovered that Elmwood Technology recorded revenue from a major contract entered into in January in the amount of $300,000 in the current fiscal year. The services associated with this revenue are to be delivered evenly over the next 3 years, and Elmwood uses accrual accounting. Calculate the amount of revenue that should be correctly recognized in the current fiscal year and provide the journal entry to correct the error. Okay, so the question is, under accrual accounting, can they recognize all of this income right away because they already received the money, or do they need to recognize less of it because it's going to be used over the next 3 years? Is there an adjustment necessary? That's what we're trying to find out. So if you have an idea, go ahead and pause the video and figure it out yourself. If not, let's go ahead and look at the answer to learn together. All right, the answer is A. There would be $100,000 of revenue recognized in this year, and to make that correct, we have to debit revenue for $200,000 and credit unearned revenue for $200,000. And just a reminder, revenue is on the income statement. Technically, unearned revenue is on the balance sheet. So even though we're talking about the income statement, a lot of the time, the adjustments that you make do affect the balance sheet. Unearned revenue is a liability. But let's read this explanation. Under GAAP, for accrual accounting, the revenue recognition principle dictates that revenue should be recognized when it is earned, not necessarily when payment is received. Since the revenue of $300,000 pertains to services to be delivered over 3 years, it should be recognized evenly over that period. So again, the correct revenue for the current year is that total revenue of $300,000 divided by the number of years that it's going to be used, and that gives you $100,000 in the current year. Thus, only $100,000 of the $300,000 should have been recognized in the current fiscal year. The premature recognition of the additional $200,000 must be reversed, and so that's why we have that appropriate journal entry of debiting revenue to decrease it by $200,000 and crediting unearned revenue to increase the liability account representing revenue that is not yet earned for services to be provided. So again, that is technically an adjustment on the income statement and on the balance sheet, and you'll see that that happens a lot of the time. In the video where we talked about adjusting balance sheet entries, we very frequently had to adjust the retained earnings on the balance sheet because of something that happened on the income statement. So those are just some things you have to consider whenever you're doing these kinds of adjustments. Let's go to the next question. All right, here we are at question 3. Pine Valley Enterprises purchased manufacturing equipment 5 years ago for $500,000 with an initial estimated useful life of 5 years and a salvage of $50,000. The company used the straight-line depreciation method for the first 4 years. At the beginning of the 5th year, a reevaluation determined that the remaining useful life was only 3 more years instead of the original 6 years, with no change to the salvage value. So again, this is at the beginning of the 5th year, so 4 years have passed. 6 years is supposed to be what the remaining useful life is with, again, including the 5th year. But now they're reevaluating it to only have 3 more years, including the 5th year. So we have to calculate what the depreciation expense is that should have been recorded in the 5th year, taking into account that now they're reevaluating it as only having 3 more years left of useful life. So think about it. Pause the video if you want to think about the accumulated depreciation and how this all changes. And when you're ready, come back, we'll look at it together. All right, the answer is $90,000. So let's walk through this. First, we have to calculate the accumulated depreciation up to the 4th year. So again, those 4 years that they had it where they had accounted for the depreciation. That means you have to take the cost, which is $500,000, less the salvage value, that's $50,000, all divided by 10. That gives you $45,000 of depreciation that was taken for the past 4 years each year. So you multiply that by 4, that gives you $180,000. Subtract that from the original cost, and that means you have $320,000 of adjusted or remaining basis. But now they're thinking that they're only going to be able to have it for another 3 years instead of another 6. So you take the remaining value, which is this $300,000, and now you divide it, and then you still subtract the salvage value if it hasn't changed or whatever the salvage value is that they're expecting, and then you divide it by the remaining years that they expect, and that gives you how much depreciation should be recorded in each of the next 3 years. And again, that includes the 5th year that they are in. So in the 5th year, because it's a part of the next 3 years, they're going to recognize $90,000 of depreciation from year 5 and onwards. So that's why we have this adjustment of $90,000 for the depreciation that hadn't been recorded yet, but we also had to take into account the change in the estimation of the useful life. All right, let's go to the next question. All right, here we are at question 4. During a year-end review, it was discovered that Springwood Inc. did not record a legal settlement received in the amount of $75,000 related to a lawsuit for patent infringement. This settlement amount is unusual and infrequent for Springwood Inc. Determine whether this income should be recorded on the income statement and suggest the appropriate journal entry. Okay, so how should this be recorded? If it should be recorded at all on the income statement, based off of the options that we have, it probably should be on the income statement in some way. So think about it. If you don't really know how this works, that's okay. We can dive straight into the answer. All right, here is the answer. B, non-operating income is where it should be. And then there's a debit to cash and a credit to the legal settlement revenue. So let's walk through this. The legal settlement of $75,000 received from a patent infringement lawsuit should be classified as non-operating income since it does not arise from the primary business activities of the company and is considered unusual and infrequent. So again, because it's not a part of normal operations, it's not going to be included in the operating section of the income statement. But since it wasn't recorded, we have to make a journal entry for that. So to correct that, we debit cash because they received that $75,000. Again, that's on the balance sheet. A lot of times, things are connected between the balance sheet and the income statement because it all flows together. And then they have to credit the legal settlement revenue for $75,000 because, again, that should have been recorded, but it's going to be under the non-operating income. This entry ensures that the income is accurately reflected in the non-operating section, which helps in distinguishing core operational performance from other financial activities. So it's not only important to know when you need to make an entry and know what's missing, but it's also important to know where you need to put that money or that expense so that it reflects correctly on the income statement. Let's go to the next question. All right, here we are at question 5. During its financial year-end closing, it was discovered that Hazelwood Corp. Incorrectly recorded a net income of $123,450 from discontinued operations as part of its continuing operations. The corporate income tax rate is 30%. Determine the effect of this misclassification on the income tax paid by the entity and provide the journal entry needed to correct the error. So again, this is a discontinued operation that was recorded in the continuing operations. So how does this affect the taxes specifically? Think about it. Pause the video if you need to. Come back when you're ready. All right, here we are at the answer. The answer is A. It's going to be overstated by $37,035. And to fix it, we have to debit tax payable for that same amount and credit income tax expense for that same amount. So let's walk through this. The incorrect recording of net income from discontinued operations in continuing operations would lead to an overstatement of taxable income from continuing operations. This misclassification artificially inflates the income tax liability associated with continuing operations. So we have to figure out how much of a tax effect this had. We have to take the $123,450, multiply it by the tax rate, that gives us that $37,035. Since the net income from that discontinued operations should not affect the taxable income from continuing operations, this amount that we just talked about, that $37,035, is an overpayment of taxes under the continuing operations. So to correct that, we have to debit the tax payable to reduce the taxes payable, because again, they had a liability account that was related to the taxes needing to be paid, so they don't need to pay those taxes now. And then you credit the income tax expense to get rid of the tax expense, because again, it shouldn't have been there, it should have been reported somewhere else. This adjustment ensures that the tax expense and payable accurately reflect the correct tax obligations for continuing operations, separating the financial impact of discontinued operations. So we've walked through a whole bunch of different adjustments that you can make to the income statement and how the journal entries might look. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you go through the questions to learn the material, you will notice things that keep popping up. You will notice, oh, these are the kinds of adjustments that they're trying to teach me to make. Or, oh, this is the kind of journal entry that I see very frequently when I'm doing these adjustments for the income statement. And you take note of those things so that you know them for later and you write them down. Let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. So for misclassification of income and expenses, misclassifications between income and expense accounts, such as recording rental income as an expense, must be corrected through reversing the original entry and then making the appropriate entry. We didn't really talk about that too much, but you may see that in other instances. For recognition of revenue, revenue should be recognized when earned, not necessarily when received. Premature or delayed recognition, such as revenue from multi-year contracts, needs adjustment to align with the accrual basis of accounting. And again, a lot of the time you are dealing with accrual basis of accounting when it comes to bigger businesses or when it comes to GAAP. So that was why I wanted to talk about that in this video. For the depreciation adjustments, changes in the asset's useful life or salvage value require adjustments in depreciation calculations, impacting both the current and future periods' depreciation expenses. And again, if you haven't recorded the depreciation, that needs to be recorded and you need to take that into account. For classification of non-operating income, items not related to core business operations, such as legal settlements from lawsuits, like we talked about, should be classified as non-operating income to avoid distorting the operational profitability. So if you find something that is in operating income or operating expense, but it should have been a non-operating income or expense, you have to make that adjustment. And then as far as tax implications of misclassified income, misclassifying income can affect the calculation of taxable income and tax expenses, necessitating adjustments to reflect the correct tax obligations based on accurately reported income streams. And this is talking a lot about the difference between continuing operations and discontinued operations. You have to make sure that things are in the correct place on the income statement so that you're not taxing the wrong things. And with that, those are the pillar topics, and that is the end of the video. Before you go, make sure to check out our free 1-hour webinar training on superfastcpa.com. Again, it is only 1 hour, it is free, and we will teach you how to pass the CPA exam effectively and efficiently. And if you liked going through these 5 questions with me, make sure to like the video and leave a comment. And remember that if you become a Superfast CPA member, you will have access to the full 10-question video when we post it in the members forum. So you can get more of this if you like it. I hope this was helpful, and I will see you in the next video.